Welcome, and thank you for joining us for today's deep dive. We are really thrilled to have you here with us.
Yeah, absolutely. Thrilled to be here.
You, the learner, the one who is, constantly seeking to understand the hidden gears turning behind the scenes of our daily lives. Today, we are looking at a really fascinating stack of materials.
Oh, it is. It's a massive stack.
Right, it's this comprehensive set of academic analyses, legal breakdowns, and real-world case studies centered around something you already know is a massive financial vehicle. But we aren't here to talk about your standard deductibles or, how to shop for a better rate.
No, not at all. That would be a bit dry.
Yeah, exactly.
Yeah.
Our mission today is to really uncover the foundational legal paradoxes and this centuries-old machinery of risk, trust, and strategy that keeps the multi-trillion-dollar insurance industry from collapsing into, well, a massive unregulated casino.
Which it very easily could be.
Right. We are going to explore the strict rules that literally keep global commerce functioning. Without this invisible scaffolding, modern business would grind to an absolute halt.
It's fantastic to be here, and I completely agree with that framing. When you really, strip it down to the studs, insurance is not a mere financial product.
No.
It is a profound social contract. It's a system built on incredibly deep questions about human vulnerability, corporate responsibility, and how we mathematically choose to handle the unknown.
I love that. Mathematically handling the unknown.
Yeah, and I'm very much looking forward to exploring the friction between these legal principles today. We aren't just going to look at what the rules of the industry are, but the specific, often brutal historical lessons that force those rules into existence in the first place.
And that is exactly where I want to start. You look at how corporations and legal systems handle this, and it all begins with the definition of the core machinery, right? The contract itself. But an insurance contract is legally distinct from almost every other agreement we make in business. It's defined in the sources as a contingent contract. There's an offer made by the person facing the risk, accepted by the underwriter issuing the policy, but it's entirely based on a contingency.
Yes.
It is an exchange of promises, not an immediate exchange of goods.
That distinction is critical, and it's something even seasoned business owners occasionally misunderstand.
Really?
Oh, yeah. In a standard commercial contract, the transaction is absolute. You pay a vendor $100,000 and they deliver a fleet of delivery vans. It is guaranteed.
You get what you pay for.
Exactly. But an insurance contract is what we call aleatory.
Aleatory.
Right, meaning it is entirely dependent on an uncertain event. You are paying a specified consideration, the premium, for a promise to compensate you for a loss resulting from designated hazards.
Right, and the catch is that if the hazard never occurs, you never get a financial payout. You essentially paid for nothing tangible.
I would actually push back on the idea that you paid for nothing tangible.
Oh, really? How so?
Because the transaction is fully complete the moment the policy is bound. What you actually purchased was the transfer of risk. You bought balance sheet protection.
Ah, I see.
The insurer is legally able to make this massive promise because they are engaged in the dedicated enterprise of distributing that specific risk among a massive pool of participants.
Okay, that concept of a dedicated enterprise brings up a brilliant exception from the reading that I want to explore. Let's look at the retail sector.
Okay.
If I walk into a major electronics retailer and buy, say, a $5,000 server for my office, and they sell me a 3-year extended warranty to replace it if it breaks.
Sure. Happens all the time.
I am transferring risk. I am paying a premium. But legally speaking, that retail warranty is not insurance, is it?
It absolutely is not. And that is a legal line in the sand that regulators guard fiercely. Retail warranties or service contracts do not constitute insurance. The fundamental difference comes down to the primary business of the entity issuing the contract. A contract is only considered to be insurance if the enterprise distributing the risk is engaged primarily in the business of insurance.
So because the electronics retailer is primarily in the business of selling servers.
The risk distribution of the warranty is purely incidental to the sale of the merchandise.
That is fascinating.
And the reason this distinction matters is regulatory survival. Real insurance companies have to adhere to incredibly strict statutory laws. They have to maintain massive capital reserves, undergo rigorous stress testing, and adhere to strict administrative agency regulations because their entire existence is predicated on absorbing societal risk.
Right. They're holding the bag for millions of people.
Exactly. If an electronics retailer had to meet the capitalization requirements of an insurance company just to offer a replacement plan on a server battery, they would go bankrupt overnight. They are legally exempted because the risk is incidental to the product.
That makes perfect sense. So we've used this word risk a few times, and obviously everyday life and global commerce carry the risk of enormous financial loss. But the industry has to define risk with much more precision than just, something bad that might happen.
Oh, definitely.
How do actuaries and underwriters actually quantify the unknown?
Well, in strict underwriting terminology, risk is defined as the uncertainty concerning the occurrence of a loss. But crucially, it is mathematically measured by the variation from an expected outcome.
Variation from an expected outcome.
Yes, it is measurable unpredictability. And to even begin underwriting, the industry categorizes this uncertainty into several fundamental divisions. The first, and arguably the most important, is the line between pure risk and speculative risk.
Okay, let's break that down because I find the corporate application of this fascinating. Pure risk involves only the possibility of loss, right?
Correct.
There is absolutely no upside. If my manufacturing plant catches fire, I only lose. I do not stand to make a profit from the fire itself. Speculative risk, on the other hand, involves the possibility of gain. If I invest $10 million into researching a new software product, I might lose my entire investment if the market hates it, but I also might capture the entire market and quadruple my money.
That is the exact dichotomy. And the golden rule of the industry is that pure risk is insurable, while speculative risk is fundamentally uninsurable.
Because if you could insure speculative risk, you would just be underwriting a casino. You'd be guaranteeing venture capital bets, which would destroy the mathematical foundation of the entire risk pool.
Precisely. If a company could buy a policy that guaranteed their new software would generate $50 million in revenue, there would be no free market. The insurer would be taking on all the downside of capitalism with none of the upside.
Right.
The second major division to understand is fundamental versus particular risk. Fundamental risks are macroeconomic or widespread catastrophic events that affect massive segments of the population simultaneously. We are talking about severe regional flooding, a nationwide economic depression, or hyperinflation.
Whereas particular risks are entirely individual in nature, like a specific warehouse being burglarized or a single delivery truck crashing on the highway.
Exactly. Now, why does this distinction matter to an underwriter? Particular risks are the historical bread and butter of the industry because they are isolated and statistically predictable.
Right, the law of averages works in their favor.
Yes. If one delivery truck crashes, the insurer has the premiums from 10,000 other safe delivery trucks to easily cover the loss. But fundamental risks are terrifying to insurers because they trigger a catastrophic aggregation of claims.
A catastrophic aggregation. That sounds bad.
It is. If a massive hurricane destroys an entire coastal city, tens of thousands of policyholders file total loss claims on the exact same day. It threatens to completely drain the capital reserves of the insurer.
Which is why you see insurers requiring highly complex reinsurance treaties, which is essentially insurance for the insurance companies, or even government backstops to handle fundamental risks.
Exactly.
But there's a third division that I think is incredibly relevant today. Static versus dynamic risk.
This is where risk analysis meets modern economics. Static risks are the perils that are always present, regardless of whether the economy is booming or in a recession. Natural perils like lightning, or human perils like embezzlement and theft.
Because human nature doesn't change much.
Right. Because human nature and weather patterns are relatively constant over long periods, static risks are highly predictable using decades of historical data. Dynamic risks, however, are the risks resulting from shifting economic changes, changes in consumer tastes, or rapid technological obsolescence.
So if a company builds a massive factory to produce internal combustion engines and government regulations globally shift to mandate electric vehicles within 5 years, rendering their entire product line obsolete.
That is a dynamic risk.
It is, and historically, dynamic risks are considered uninsurable. They are simply too unpredictable, they don't follow historical actuarial tables, and they are deeply intertwined with speculative business decisions.
Right, you cannot buy a policy to protect your company from becoming the next blockbuster video.
Yeah. Knowing that not everything can be insured, it highlights that buying a policy is just one tool in a corporate arsenal. When you look at enterprise risk management in the texts, there are really only 4 specific strategies a company can deploy.
Yes, insurance is merely the final backstop in a broader philosophy. The first strategy is avoidance.
Avoidance, okay.
If a pharmaceutical company determines that the liability risk of developing a certain type of experimental drug is too high, they simply scrap the project. They avoid the risk entirely. It's effective, but it stifles growth.
Right. You can't make money if you don't do anything.
Exactly. The second strategy is reduction. You accept the risk, but you aggressively invest in mitigating the severity or frequency of a loss.
Like a logistics company installing AI-driven dash cams and automatic braking systems in every truck, or a chemical plant installing state-of-the-art fire suppression systems.
Yes.
And the incentive here is financial, right? Because underwriters will drastically reduce your premium if you can objectively prove you've lowered the variation from the expected outcome.
Absolutely. The third strategy is assumption, commonly known as self-insurance. This is a highly calculated move where a corporation decides the cost of the premium is higher than the statistical cost of the loss, so they retain the risk themselves.
So they just pay out of pocket.
Essentially, yes. A massive multinational retailer might decide that instead of paying exorbitant premiums to cover minor slip and fall claims across their 1,000 stores, they will simply set aside their own liquid cash reserves to pay those inevitable settlements directly. They assume the risk.
Okay. And the fourth,
And finally, we have transference.
which is the formal act of purchasing an insurance policy. You're legally transferring the financial burden of the risk to the insurer's balance sheet. And the fuel that powers that transfer is the premium.
Right.
The concept is that the premium creates a massive pool of funds from the money to pay for the unfortunate few. But the mathematics of calculating that premium for complex commercial risks must be staggering.
It is a delicate, highly regulated mathematical balancing act. The foundational calculation relies on the law of large numbers. The larger the pool of insured exposures, the more accurately the actuaries can predict the total aggregate losses that will occur in a given year.
Okay.
They calculate the total expected loss for the pool, then they add in the insurer's operating expenses, so infrastructure, claims adjusters, legal defense costs, and a margin for profit, and then they divide that total burden proportionally.
And the proportionality is key. The company hauling hazardous chemicals pays a vastly larger slice of that premium pie than the company hauling pillows, even though they are in the same overall risk pool, because their specific risk profile demands a heavier contribution.
Precisely. That establishes the core machinery, the aleatory contract, the precise legal categorization of risk, and the mathematical pooling of capital. But to truly understand how this industry shapes society, we have to look at how it is legally bifurcated. The global insurance market is fundamentally split into two distinct universes.
Let's transition into that divide, because the legal walls between the two are absolute. We are talking about the division between life insurance and non-life insurance, which the industry refers to as general insurance.
Right.
If you look at regulatory frameworks like the IRDA Act of 1999, which governs the Indian insurance market, it mandates that life and non-life business must be conducted by completely separate corporate entities. You cannot mix the funds. A single company cannot underwrite commercial property and human lives simultaneously.
And that regulatory wall exists because the two sides operate on completely different philosophical and legal foundations. In general insurance, the foundational legal doctrine is the principle of indemnity.
Indemnity.
Right. Indemnity means making the insured whole again. It means returning them to the exact financial position they occupied a millisecond before the loss occurred. If a $50,000 piece of machinery is destroyed, the policy pays $50,000. But life insurance is fundamentally not a contract of indemnity.
Because you cannot indemnify the loss of a human life. You cannot put a fair market value on a person, and you certainly cannot repair or replace them to make the family whole again.
No, you can't.
So from a legal standpoint, how does life insurance operate if the core principle of indemnity doesn't apply?
Instead of indemnity, life insurance operates as a benefit policy. The contract states that upon the occurrence of the specified event, usually death, the insurer will simply pay a pre-agreed, specified claim amount to the beneficiaries.
Okay.
The value isn't based on the financial worth of the person. It is determined entirely at the inception of the contract based on what the insured individual chose to purchase and what level of premium they could consistently afford. Life insurance is structurally designed to hedge against two opposing human timelines.
Right. The first is the obvious one, the risk of premature death.
Yeah.
The risk that you pass away before you have accumulated the necessary wealth to support your dependents or pay off your massive mortgage.
Exactly.
But the second risk is one that people rarely think of as an insurable peril. The risk of living too long.
What actuaries call superannuation, the terrifying financial risk of completely outliving your accumulated capital. Life insurance products step in to manage both extremes of that timeline. The most basic element is term insurance.
Right, term life.
This is pure risk cover for a strictly defined period. You purchase a 20-year term policy. If you die within those 20 years, the death benefit is paid. If you live to year 21, the policy simply expires, the premiums are gone, and nothing is paid out. It is pure, unadulterated protection.
But the global market, particularly in regions like India, leans heavily toward a much more complex structure. The endowment policy. This completely changes the math, because an endowment policy combines the pure risk cover of term insurance with a massive guaranteed savings and investment component.
It does, and the appeal of the endowment structure is the certainty it provides. It is designed so that a claim will be paid out no matter what happens.
Wait, really? No matter what?
Yes. If the insured passes away during the term, it pays out as a death claim. But if the insured survives to the end of the specified term, it pays out as a maturity claim. It acts simultaneously as a safety net for dependents and a forced, guaranteed wealth accumulation vehicle for the insured's own future.
But think about the pressure that puts on the insurer. If they are legally guaranteeing a massive payout to every single person holding an endowment policy eventually, how do they calculate a premium that won't bankrupt them over a 30-year timeline?
It's extremely complex.
The variables are intense. You have the mortality rate, which dictates when the claims are statistically likely to hit. You have the operating expenses. But the linchpin that makes the whole thing work has to be the interest rate, right?
The interest rate is the absolute engine of life insurance. Because these are incredibly long-term contracts spanning 20, 30, or even 40 years, the insurer collects an ocean of premium capital upfront and continuously over decades. Regulators mandate that these long-term premiums cannot sit idle. They must be deployed into highly secure income-yielding investments.
Like what kind of investments?
Government bonds, high-grade corporate debt, massive infrastructure projects.
And the compound interest earned on those investments is actually what subsidizes the cost of the policy.
Exactly. The investment yield is what allows insurers to offer a level premium. Think about the biological reality. Your statistical risk of dying increases every single year you age. In a pure system, your premium should skyrocket every year.
Because you're getting older and closer to death.
Exactly. But a level premium means you pay the exact same amount at age 25 as you do at age 65. The actuaries calculate the total lifetime cost, smooth it out, and rely on the fact that you are vastly overpaying in your 20s.
Oh.
They take that overpayment, invest it for decades, and the compound interest funds the inevitable payouts when the entire pool reaches their 70s.
To manage a system like that, tracking customized endowment payouts, adjusting for decades of shifting interest rates, managing mortality tables for millions of policyholders, the back-end technological operations must be absolutely staggering. It's not just filing cabinets anymore. It's massive computational power.
The technology isn't just a support function. It fundamentally dictates the business capability. Take the historical evolution of the Life Insurance Corporation of India, or LIC.
Right.
For decades following its establishment in 1956, LIC effectively held a monopoly, managing an unprecedented volume of policies across a massive geography using heavily manual paper-based systems. The sheer administrative friction defined what kinds of products could be offered.
That makes sense.
When the market finally opened up to private players, the competition wasn't just about who had the best sales agents. It was about who had the most agile IT infrastructure.
And that leads perfectly into a fascinating technical case study we have regarding Sahara India Life Insurance. When they entered the market, they realized they couldn't compete using legacy fragmented servers.
No, they could.
They undertook a massive server consolidation project, partnering with IBM to deploy an OS i5 system, heavily utilizing platforms that evolved from the legendary S390 and AS400 mainframes.
Now, I know dropping terms like S390 mainframes might sound like getting lost in the technological weeds, but the business implication of that hardware upgrade is profound.
How so?
Before consolidation, if an insurer wanted to launch a highly customized endowment policy, say, one that pays a specific percentage of the sum assured at varying intervals to match a child's educational milestones while dynamically adjusting for inflation bonuses.
That sounds like a nightmare to track.
Exactly. The fragmented servers would struggle to calculate the actuarial liabilities across the entire enterprise.
By consolidating onto a robust, centralized infrastructure, Sahara achieved a massive reduction in their total cost of ownership, yes, but the critical victory was the reduction in their go-to-market time.
That's the key.
They could invent a complex hybrid insurance product on Monday, have the system validate the mathematics by Wednesday, and have their agents selling it by Friday. In the life insurance market, computational agility is a massive competitive advantage.
It is the difference between leading the market and being obsolete. Now, contrast the decades-long interest-driven world of life insurance with the chaotic, immediate reality of non-life or general insurance.
The contrast is jarring. General insurance covers almost everything else in the physical and corporate world. You have property insurance covering massive commercial real estate against fire and peril. You have motor insurance from personal sedans to fleets of long-haul trucks.
Yep.
There's liability insurance protecting businesses from catastrophic public lawsuits.
Yep.
Pecuniary insurance, which is fascinating, protecting against pure financial losses like employee embezzlement or the sudden insolvency of a major debtor.
Which is huge for businesses.
There's business interruption insurance, which pays your lost profits if your factory is forced to close. And personal accident insurance, covering sudden, unforeseen bodily injuries. The variety is endless.
It is, and the fundamental defining characteristic that ties almost all of these disparate general insurance contracts together is their duration. Unlike a 30-year life insurance policy, general insurance policies are almost exclusively annual contracts. They are written for exactly 365 days, and then they must be completely renegotiated and renewed.
Why the strict annual limitation? Why not lock in a 10-year rate on a commercial warehouse?
Because the subject matter being insured is in a constant state of physical and economic flux. A commercial building experiences daily wear and tear. A fleet of vehicles depreciates in market value the minute they hit the road.
That's true.
Industrial machinery might suffer from sudden technological obsolescence, drastically changing its replacement value. If the inherent value of the asset is constantly shifting, an underwriter cannot responsibly lock in a premium for a decade. The calculations must be refreshed annually to reflect the current immediate reality of the risk.
And this annual structure introduces a harsh financial reality for the consumer. In life insurance, especially endowments, you are guaranteed a payout eventually. But in general insurance, if you pay $100,000 to insure your corporate headquarters for the year, and the year passes without a fire, without a lawsuit, without a loss, the premium is gone. The coverage simply expires.
As the legal doctrine states plainly, no damages, no claim. You did not pay for an investment vehicle. You paid for the balance sheet protection and the peace of mind for those 365 days. The transaction is definitively over, and the insurer retains those funds to pay for the unfortunate few in the pool whose headquarters did catch fire that year.
To truly illustrate the incredible, bespoke flexibility of general insurance, how underwriters can mathematically price almost any risk, we have to look at the event insurance market. Let's talk about the Falguni Pathak Navratri case study.
Oh, this is a great one.
For those who aren't familiar, Navratri is an absolutely massive 9-day Hindu festival, and Falguni Pathak is the undisputed superstar of traditional Garba performances. Her events draw tens of thousands of people every single night.
The logistics of an event of that scale are staggering. The case study looks specifically at her Mangal Navratri event at the police parade grounds in Ghatkopar, Mumbai. The financial exposure for the organizers, Mangal Entertainment, is astronomical.
Right.
You have immense upfront costs, massive stage construction, state-of-the-art sound systems, venue leasing, expensive security cordons, heavy marketing, and of course, the artist's exorbitant performance fees.
If the event is canceled on day 2, the organizers face total financial ruin. They can't just absorb that loss. So they utilize the transference strategy we discussed earlier, turning to Future Generali India Insurance. And the coverage Future Generali provided was incredibly specific. The policy insured the organizers against cancellation due to various named perils, but explicitly included coverage for terrorism. It also covered the non-appearance of the artists owing to sudden accident or critical illness.
Let's pause and think about the underwriting required for that. If you are Future Generali, how do you price the risk of a superstar singer catching a severe case of laryngitis on day 4 of a 9-day festival? How do you price the risk of a terror threat shutting down Ghatkopar?
The analytics must be insane. They're looking at her historical health records, the structural integrity of the temporary stage, the geopolitical climate of the city, the local police presence.
Exactly. And the market rate for this kind of bespoke event insurance typically ranges from 0.30% to total 0.65% of the total insured sum, depending on the venue and the specific perils covered.
That's a very precise percentage.
It is. The chief operating officer of Future Generali at the time noted that festivals of this scale have simply become too vast to operate without an insurance backstop. The financial gravity demands it.
It perfectly illustrates that insurance isn't just about replacing dented fenders. It is the invisible safety net that allows massive cultural events, entertainment, and complex commerce to flourish. The organizers could confidently spend millions building this stage because they knew that for a fraction of a percent in premium, a sudden illness wouldn't bankrupt them.
It is a masterclass in dynamic underwriting. But this brings us to a massive legal hurdle. If Future Generali is willing to pay out millions if Falguni Pathak gets sick, what stops a random fan, or worse, a rival event promoter, from secretly buying their own cancellation policy on her event and hoping she gets sick so they can get rich?
This is the core ethical and legal question of the entire industry. What stops me from taking out $1 million fire policy on my neighbor's house and just crossing my fingers?
What stops you is the absolute bedrock principle of the industry, the principle of insurable interest. Without this principle, the entire concept of insurance instantly devolves into illegal gambling.
Illegal gambling. That's a strong way to put it.
But it's true. Insurable interest is defined as the legally recognized right to insure, arising strictly out of a financial relationship between the insured and the subject matter of the insurance.
In plain English, you must stand to suffer a direct, measurable financial loss if the insured property is damaged or the insured event occurs. If you do not have skin in the game, the contract is completely void and unenforceable by law.
And this isn't just a technicality. It is a defense against a terrifying moral hazard. If you were legally allowed to insure your neighbor's house for $1 million, you would suddenly have a very strong, highly illegal incentive to walk over there with a can of gasoline.
Right.
By mandating insurable interest, the law aligns the incentives. The insured must want to preserve the property as much as the insurer does.
The historical evolution of this principle is fascinating. The legal precedents point heavily to a landmark ruling from 1883, the case of Castellan versus Preston. The specific details of the property transfer in that case established a brilliant clarifying philosophy. The ruling stated, what is it that is insured in a fire policy? Not the bricks and materials used in building the house, but the interest of the insured in the subject matter of insurance.
That single sentence requires a massive mental shift. You are never actually insuring the physical object itself. You are insuring your legally recognized financial relationship to that object. And that legal relationship doesn't just manifest out of thin air. The law recognizes 3 primary ways an insurable interest is created: by common law, by contract, and by statute.
Let's explore how intricate this gets in the real world, starting with common law. Absolute ownership is the most obvious example. If I own a fleet of taxi cabs, I derive my livelihood from them. I have a clear insurable interest. But the moment I sell a taxi cab and transfer the title, my financial relationship vanishes, my insurable interest is extinguished, and my insurance policy on that cab is instantly void. But the law goes much deeper than just the person holding the title. What about the relationship between mortgagees and mortgagors?
This is a perfect example of how multiple distinct parties can hold separate insurable interests in the exact same physical asset simultaneously. When a corporation buys a $50 million office building using a massive bank loan, the corporation is the mortgager. They own the building, so they have an insurable interest.
Right.
But the bank that issued the loan, the mortgagee, also has a massive insurable interest because that physical building is the collateral securing their $50 million. If the building burns down, the bank's asset turns to ash.
But the bank's interest is strictly limited, right? They can't insure the building for $100 million and hope for a fire. Their interest is capped exactly at the outstanding balance of the loan.
Precisely. They can only protect their specific financial exposure. We see some more nuance with bailees.
Bailees.
A bailee is an entity that is legally holding the goods of another person. Think of a massive commercial motor garage or a high-end watch repair shop. The garage doesn't own the fleet of luxury cars sitting in their bays overnight, but they have a strict legal duty of care while those assets are in their custody.
Right, if something happens to them on their watch.
Exactly. If a fire rips through the garage due to their negligence, the car owners will sue them for the value of the vehicles. Therefore, that legal liability grants the garage owner a valid insurable interest to insure the cars while they hold them.
It's brilliant. The liability itself creates the interest. And what about complex corporate structures, like part ownership? If I am a 20% minority partner in a manufacturing facility, can I only insure 20% of the building?
Actually, the law allows a part owner to insure the entire physical structure. However, the law strictly views you as a trustee for the other co-owners regarding the remaining 80%. If the facility is completely destroyed, the insurer will pay the full claim, but you are legally only permitted to retain the funds that cover your specific 20% financial interest.
That makes sense.
You are legally bound to hold the rest of the funds in trust and distribute them to your partners. You cannot use insurance to orchestrate a hostile takeover of your partner's equity.
It's an airtight system to prevent anyone from profiting beyond their actual stake. But how does this translate to life insurance? How do we legally quantify financial interest in human relationships? The law acknowledges that a husband and wife have an unlimited insurable interest in each other's lives, reflecting the deep financial and emotional interdependence.
Yes.
But this principle is also the backbone of corporate stability. Let's talk about creditors and employers.
In the commercial realm, a creditor absolutely has an insurable interest in the life of their debtor. If a venture capitalist lends an entrepreneur $10 million to build a tech startup, the VC can take out a life insurance policy on the entrepreneur.
Okay.
However, again, it is strictly capped. The VC can only insure the entrepreneur for the $10 million owed plus reasonable interest. They cannot take out a $50 million policy and effectively put a bounty on the founder's head.
The key person insurance concept is equally critical. If a tech company has a genius lead developer whose proprietary code represents 80% of the company's valuation, the employer has a massive insurable interest in that developer's life.
Huge interest.
If that developer dies unexpectedly, the company's stock will plummet, projects will halt, and they will spend a fortune recruiting a replacement. They can legally insure the employee to bridge that financial devastation.
But again, regulators watch this closely. The death benefit must be reasonably and proportionally related to the employee's documented salary or their direct contribution to the company's revenue.
Now, here is where the legal mechanics get really tricky. We've established that this interest must exist for the policy to be valid, but when must it exist? Because the corporate world is fluid. Loans get paid off, key employees quit, buildings get sold. The timeline of insurable interest dictates everything, and the rules differ wildly depending on the sector. Let's start with the timeline rule for life insurance.
In life insurance, the strict legal rule is that the insurable interest must exist only at the time of the inception of the contract. It is not required to exist at the time of the claim.
Wait, let's explore the implications of that.
Sure.
If a corporation takes out a $10 million key person policy on their superstar CEO, and 3 years later, that CEO has a massive falling out with the board, resigns, and goes to work for their biggest rival.
Happens all the time.
The original company no longer has a financial interest in that person's success. But you're saying they can legally keep paying the premiums on that policy?
They absolutely can. If that former CEO passes away 20 years later, the original company can legally collect the $10 million death benefit. The law dictates that because the insurable interest was valid on the exact day the contract was signed, the subsequent loss of that interest does not invalidate the long-term nature of a life insurance contract.
That is wild, but I suppose it provides necessary stability for long-term investments. But marine insurance operates on the exact opposite logic.
Yeah.
In marine insurance, the interest must exist only at the time of the loss and is not required at the inception of the policy. Why the sudden reversal?
You have to look at the historical realities of global ocean commerce. Picture a massive cargo ship leaving Shanghai loaded with millions of dollars of raw silk heading for London. During that 6-week voyage, the ownership of that cargo might be traded and sold on the commodities market half a dozen times.
Okay.
A merchant in London might purchase the rights to that cargo while the ship is already 3 weeks at sea. That merchant needs the ability to instantly bind insurance the moment they take financial ownership, even though they had absolutely zero insurable interest when the voyage actually began. The system is designed to facilitate fluid global trade.
And then we land on property insurance, fire, motor, corporate liability. Here, the law demands the strictest adherence. The insurable interest must exist both at the time of inception and at the time of the loss.
Precisely. If you own a fleet of delivery trucks, you must have an interest when you buy the policy. But if you sell the fleet to a competitor on Tuesday and the trucks burn down on Wednesday, you cannot file a claim. Your insurable interest vanished the moment the title transferred, rendering the policy immediately void. The law is exhaustively designed to extinguish any scenario that even resembles an illegal wager.
Which brings us perfectly to the enforcement mechanisms of the industry. The three great legal doctrines that ensure nobody games the system: indemnity, subrogation, and contribution.
Right.
Let's unpack indemnity first. We established earlier that outside of life insurance, the goal is restitution. You are placed in the exact financial position you occupied immediately before the disaster. Not better, not worse.
The enforcement of indemnity is crucial because it acts as the final lock on the moral hazard door. It guarantees that an insured can never, under any circumstances, make a profit from a disaster. If your 10-year-old factory roof is destroyed by hail, the insurer does not owe you a brand new state-of-the-art roof that increases the value of your building. They owe you the depreciated actual cash value of a 10-year-old roof.
And the insurer actually has a lot of strategic flexibility in how they provide that indemnity. They don't just have to write a blank check. There are 4 recognized methods of indemnity. The first is cash payment, which is the most straightforward. The adjuster calculates the depreciated loss, and they wire you the funds. But the second method is repair, and this is where insurers exercise massive leverage.
Repair is incredibly common in motor insurance. An insurer won't just hand you $10,000 based on a repair estimate. They will authorize specific, heavily vetted network garages to carry out the repairs directly.
Oh, I've had to do that.
Right. And the vertical integration here is a fascinating business strategy. In some global markets, massive insurance conglomerates actually outright own the repair garages, and they invest heavily in automotive research to develop cheaper, faster repair techniques to drive down their own aggregate claim costs.
The third method is replacement. If your retail store is vandalized and the massive plate glass windows are smashed, the insurer might not bother writing a check. They will simply order their contracted glass supplier to install exact replicas of the same kind and quality.
Exactly.
And the fourth method is reinstatement, which is the nuclear option for massive property damage. If a commercial warehouse burns to the ground, the insurer can elect to bypass a cash settlement, hire their own commercial contractors, and physically rebuild the structure to its pre-fire specifications.
Insurers often utilize reinstatement if they suspect the insured is inflating the cash value of the claim. It's a way of saying, we won't argue over the hypothetical cost. We will just rebuild the asset ourselves.
But there is a massive, often misunderstood trap hidden within property insurance, designed to punish corporations that try to game the premium calculations. It's called the condition of average, or the severe penalty of underinsurance.
This is a vital mathematical concept. The entire insurance ecosystem relies on the fact that insurers are merely the trustees of a communal pool of premium capital. Every policyholder is expected to bring a mathematically fair, honest contribution to that pool based on the true value of their risk.
Okay.
If a corporation deliberately underinsures their assets to artificially lower their premium costs, they are severely shortchanging the pool.
Let's walk through a precise mathematical example of how this trap springs from the reading. Let's say a business owner, Mr. Suthir, owns a commercial warehouse with a true objective market value of $10 million.
Okay, $10 million.
But Suthir wants to cut his operational expenses. He thinks the building is mostly concrete and will probably never burn to the ground completely. So he deliberately chooses to only insure the building for $5 million. He is objectively underinsured by exactly 50%.
Right, he's taking a gamble.
A year later, an electrical fire breaks out in the storage room. It is extinguished quickly, but it causes exactly $1 million in structural damage. Suthir files a claim. He thinks to himself, I have a $5 million policy limit. My damage is only $1 million. I am well within my limits, so the insurer will just write me a check for the full $1 million.
And that is exactly where the condition of average violently corrects his math. The underlying principle dictates that by underinsuring his property by 50%, Suthir legally elected to become his own insurer for that uninsured half of the risk.
The formula for the penalty is brutal, but entirely fair. The claim payable equals the actual loss, multiplied by the sum insured, divided by the true market value.
Let's run Suthir's numbers. His actual loss is $1 million. You multiply that by his $5 million sum insured, which gives you $5 million. You then divide that by the $10 million true market value. The result is $500,000. The insurance company will only pay Sudhir $500,000.
He has to pay the remaining $500,000 out of his own corporate treasury to fix the warehouse. He thought he outsmarted the actuaries by saving a few $1,000s on his premium, and it cost him $500,000 in an uncovered loss. It is a brilliant, self-correcting mechanism that forces honesty in valuations.
It ensures the integrity of the capital pool. Now, the complexities of indemnity multiply exponentially when a negligent third party enters this scenario.
Let's construct a scenario.
Yeah.
I own a logistics company. One of my delivery vans, fully insured, is legally parked. A negligent driver from a rival company is texting, runs a red light, and completely totals my van. It is 100% their fault. I have two obvious paths. I can file a claim with my own insurance company to get my van replaced instantly, or I can hire a lawyer and sue the rival company for the damages.
Right.
But what if I do both? What if my insurer pays me $50,000 to replace the van, and then I successfully sue the rival company for $50,000 and pocket the cash? I just turned a $50,000 asset into $100,000.
You cannot do that, and the mechanism that stops you is the doctrine of subrogation. Subrogation literally means substituting one creditor for another. It is the most powerful extension of the principle of indemnity.
How does it work?
The doctrine dictates that the absolute second your insurance company pays your claim and makes you whole, they instantly and legally inherit your right to sue the wrongdoer. They step directly into your shoes.
Because the law recognizes that since the insurer bore the financial burden of the loss, the insurer alone now possesses the right to recover those damages from the negligent party. You cannot double dip. In fact, if you somehow manage to recover funds from the at-fault driver after your insurer has already paid you, you do not own that money. You are legally required to hold it in trust and hand it over to your insurer.
Exactly. And the legal avenues through which this right of subrogation arises are fascinating. The first is through tort, which is exactly the vehicular negligence scenario we just discussed. Civil wrong was committed, the insurer indemnified the victim, and now the insurer assumes the right in tort to sue the negligent party.
But there's a vital procedural nuance here. When the massive insurance conglomerate sues the negligent driver, they don't sue under their corporate name. The insurer must take legal action in the name of the insured, and they generally must seek the insured's permission before initiating proceedings.
The reasoning behind that is to protect the insured from fragmented litigation. The law generally frowns upon suing a person multiple times for the exact same event. If the insurer sues the driver just for the property damage to the van, they might exhaust the legal remedies. But what if the driver of the parked van suffered severe spinal injuries that weren't covered by the property policy?
Right. The driver needs to sue for that.
The insured needs to be able to join the lawsuit to recover their uninsured personal injury damages alongside the insurer's property recovery.
The second way subrogation arises is by contract. If you have a strict contractual agreement that a vendor must compensate you for errors regardless of fault, your insurer inherits that contractual right upon paying your claim. But the third avenue is where the intersection of insurance and state power gets wild. Subrogation by statute.
This highlights how deeply intertwined insurance capital is with the legal responsibilities of the government. A classic historical example is the Riot Damage Act of 1886 in the United Kingdom.
This is incredible. The premise was that preventing riots and maintaining civil order is the fundamental duty of the state police authorities. So, if a riot breaks out and destroys a commercial district, the property insurers obviously have to pay out millions in claims to the business owners.
Naturally.
But under the Riot Act, the insurers were granted statutory subrogation rights to turn around and sue the district police authorities to recover those massive payouts, arguing the police failed in their statutory duty to prevent the damage.
The insurer literally sues the government on behalf of the citizenry to recover the risk pool's capital. The fourth avenue of subrogation is through the subject matter of insurance, which deals heavily with the concept of salvage.
Let's go back to my total delivery van. If the van was worth $50,000 and the insurer writes me a check for the full $50,000, making me 100% whole, I don't get to keep the wrecked, twisted metal chassis of the van parked in my lot. If I kept it and sold the scrap metal to a junkyard for $3,000, I would have received $53,000 for a $50,000 loss, violating the principle of indemnity.
Correct. Upon paying a total loss claim, the insurer instantly takes legal ownership of the salvage. When the insurer hauls that wreck away and sells it to the junkyard, they are exercising their right of subrogation to mitigate their own losses and replenish the capital pool.
Now, timing is everything in law. According to strict common law, an insurer's right of subrogation doesn't actually crystallize until after they have fully admitted the claim and physically transferred the indemnity funds to the insured. But waiting for that check to clear creates massive strategic vulnerabilities.
Delay is the absolute enemy of legal recovery. If a complex commercial fire takes 6 months for forensic accountants to fully adjust and pay the claim, the negligent contractor who started the fire might declare bankruptcy, flee the jurisdiction, or destroy critical evidence.
That makes sense.
Furthermore, the insured business owner, not realizing the implications, might sign a hasty settlement agreement with the contractor, accidentally waiving their rights to sue, which means the insurer inherits nothing.
So the industry adapted. To maintain aggressive control over the recovery process from day one, modern commercial policies contain an express subrogation condition. This contractual clause grants the insurer subrogation rights before the claim is officially paid. It allows the insurer's legal team to immediately slap injunctions on the third party, freeze assets, and secure the legal battlefield while the slow process of indemnity is still being calculated in the background.
It is aggressive, necessary legal maneuvering to protect the macro stability of the premium pool. Now, we've looked at insurers battling third parties. Let's look at the mechanisms deployed when insurers have to battle each other. This brings us to the doctrine of contribution.
This deals with the chaos of overlapping policies. Let's create another corporate scenario. I own a massive distribution center. I'm paranoid about losing it, so I take out a $20 million fire policy with Insurer A. A month later, feeling insecure, I take out a second, completely separate $20 million fire policy on the exact same building with Insurer B. The building burns to the ground, a total $20 million loss. Can I file a full claim with Insurer A, get my $20 million, and then file a full claim with Insurer B and get another $20 million, doubling my money?
Once again, the ironclad principle of indemnity blocks you. You can never recover more than your actual verified financial loss. You are capped at $20 million. However, under common law, you hold the power to choose. You can submit the entire $20 million claim to Insurer A, force them to pay it in full, and completely ignore Insurer B.
But that is incredibly unfair to Insurer A. They just absorbed a catastrophic loss while Insurer B sits on their premium and pays nothing for the exact same risk.
And that profound inequity is why the courts evolved the doctrine of contribution. Contribution is the legally enforceable right of an insurer who has paid a loss to legally compel other insurers who are also liable for that exact same loss to reimburse them for a proportionate share.
So after Insurer A writes me the $20 million check, their lawyers immediately turn around and use the doctrine of contribution to sue Insurer B, forcing Insurer B to hand over $10 million, so they both share the loss equally.
Precisely. However, insurers fight contribution claims viciously, so the legal system established 5 incredibly strict conditions that must all be perfectly met before the doctrine applies.
Right.
If even one condition fails, contribution is denied. First, there must be 2 or more active policies of indemnity in existence. Second, the overlapping policies must cover a common interest. Third, they must cover a common peril. Fourth, they must cover a common subject matter. And fifth, all policies must be legally operational and valid at the exact time of the loss.
Let's test those conditions to show how strict they are. Suppose Insurer A's policy covers the building against fire, but Insurer B's policy only covers the building against flood. The building burns down. Contribution does not apply because there is no common peril. Insurer B has 0 liability for a fire. Insurer A eats the entire loss.
Exactly. Or consider common interest. Suppose a landlord insures a commercial building, and the tenant independently insures their specific leasehold improvements within the building. A fire destroys everything. The landlord's insurer pays the landlord, the tenant's insurer pays the tenant. Contribution does not apply between the 2 insurers because, while the subject matter, the building, is physically the same, the legally recognized insurable interests are completely separate. There is no legal overlap to share. The precision required to trigger contribution is a masterpiece of legal engineering.
Which perfectly sets the stage for our final exploration. We have discussed all these complex enforcement mechanisms, subrogation, contribution, penalties for underinsurance. But none of this intricate legal architecture can function if the foundation of the contract is built on a lie. This brings us to the fundamental behavioral rule that governs the entire industry: utmost good faith and the paper trail that makes it actionable.
The legal term is uberame fide, and it represents a radical departure from standard commercial law. In almost every other business transaction, the prevailing doctrine is caveat emptor, or buyer beware.
Right. If I buy a used fleet of trucks from a competitor, and I don't bother to hire a mechanic to inspect the transmissions, and 3 days later the transmissions all fail, that is largely my fault for not exercising due diligence. The seller isn't legally obligated to volunteer the fact that the trucks are in bad shape unless I specifically ask.
Exactly. But an insurance contract demands a vastly superior standard of honesty from both sides. The doctrine of utmost good faith imposes a strict, positive legal duty to voluntarily disclose, accurately and fully, all facts material to the risk being proposed, whether the other party explicitly asks for them or not. You cannot hide behind the excuse that the underwriter forgot to ask.
The operative phrase there is material fact. The law defines a material fact as every circumstance or piece of information which would influence the judgment of a prudent, rational underwriter in assessing the risk. It's any piece of data that would cause them to either refuse to issue the policy entirely, dramatically increase the required premium, or insert specific restrictive clauses into the contract.
Let's use a stark commercial example. You are applying for a multi-million-dollar fire insurance policy for a standard clothing manufacturing facility. The application form asks standard questions about the square footage, the sprinkler systems, and the type of electrical wiring. You answer them all truthfully.
Okay, sounds good so far.
However, you fail to mention that you are secretly subletting a corner of the basement to a company that manufactures highly combustible industrial solvents. Even if the application form didn't specifically contain a question asking, do you store explosive chemicals in the basement? The presence of those chemicals is an undeniably material fact. It radically alters the true nature of the risk you are asking the insurer to absorb. You have a positive, proactive legal duty to disclose it.
And what happens if you don't? But what if it's an honest mistake? What if an administrative assistant filled out the form and genuinely didn't realize the basement tenant was a material fact? The legal consequences are absolute, aren't they?
They are draconian. The law states that failure to reveal a material fact, or the misrepresentation of a material fact, grants the aggrieved party the right to treat the entire contract as void ab initio, meaning void from the very beginning. And crucially, it does not matter if the non-disclosure was a calculated, intentional fraud or completely innocent oversight.
Wow.
If the material fact was hidden, the underwriter was deprived of the opportunity to accurately price the risk. The insurer can legally walk away from the claim, refuse to pay a single dime, and simply refund your premium.
While insurers hold the power to waive an innocent breach if they choose, relying on the mercy of an underwriter after a $10 million loss is a terrible corporate strategy. And the tragic reality of these strict disclosures and policy definitions is often only realized after catastrophic events. We have a sobering historical reference regarding the devastating Gujarat earthquake.
The aftermath of that disaster revealed a heartbreaking gap between public perception of insurance and the strict legal reality of the contracts. Following the earthquake, thousands of businesses and homeowners whose properties were reduced to rubble filed claims, only to discover they were entitled to absolutely no relief from their insurers.
The public outrage was immense, but legally the insurers were largely protected by the principle of utmost good faith and the specific terms of the contracts. The standard fire insurance policies those individuals purchased simply did not include earthquake coverage as a standard peril. It was an exclusion. Earthquake coverage was readily available in the market, but it required the insured to specifically request it, disclose their structural details, and pay an additional premium for an add-on cover.
It is a devastating reminder that an insurance policy is a highly specific legal instrument governed strictly by the exact words written on the page and the facts disclosed at inception. It is not a blanket guarantee of financial salvation.
And managing all those exact words, verifying those disclosures, and proving to the world that these risk transfers are actually valid requires an incredibly robust administrative paper trail. This isn't just theory, it's the daily operational friction of global business. Let's look at the mechanisms that prove this massive system is working, specifically the certificate of insurance.
The certificate of insurance is where the high-minded legal theories of risk transference meet the harsh reality of daily commerce. A certificate is a formal, standardized document issued by the insurance company at the direct request of the policyholder, serving as indisputable proof of coverage to third parties.
It is the passport that allows business to happen. Without it, the gears stop turning. The materials outline 3 major corporate applications, starting with the certificate of car insurance. Now, we all know the little ID card we keep in the glove box for traffic stops, but in commercial finance, it is vastly more complex.
If a logistics company finances a massive fleet of long-haul trucks through a major commercial bank, the bank does not just take their word that the trucks are insured. The trucks are the bank's collateral. The bank will demand a formal certificate of insurance that explicitly lists the bank as a loss payee or an additional insured.
Right.
This legal designation ensures that if a truck is totaled, the insurance company is legally obligated to write the settlement check directly to the bank to clear the loan, rather than handing the cash to the logistics company, who might use it to fund payroll instead.
It is a mechanism to aggressively protect the creditor's insurable interest. The second critical type is the certificate of liability insurance. This is the absolute lifeblood of commercial real estate and corporate contracting.
Consider the leasing of a major commercial building. A property management firm will absolutely refuse to hand over the keys to a new corporate tenant until they receive a valid certificate of liability. The landlord needs irrefutable proof that if a client slips on a wet floor inside the tenant's office and sues, the tenant has a multi-million-dollar liability policy ready to absorb the legal blow. Without that certificate, the landlord is dangerously exposed to being dragged into the lawsuit.
You see the exact same friction in vendor relationships. If a corporation hires a third-party IT firm to come into their headquarters and install new server racks, the corporation demands a certificate of liability from the IT firm. Why? Because if the IT technician accidentally sparks an electrical fire that burns down the server room, the corporation needs to know the IT firm's insurer is legally bound to pay for the damages. Providing that certificate is a strict prerequisite for stepping foot on the premises.
And the most complex interplay of these certificates is found in the construction industry, particularly regarding the Certificate of Workers' Compensation Insurance.
Let's build a hypothetical skyscraper. You have a massive real estate developer who hires a general contractor to oversee the project. That general contractor then hires 50 different specialized subcontractors, plumbers, steelworkers, electricians. The site is a massive web of physical risk.
In that scenario, the general contractor's legal team will relentlessly demand an up-to-date certificate of workers' compensation from every single one of those 50 subcontractors before allowing their crews on site. The legal vulnerability is massive.
Definitely.
If a subcontractor steelworker falls off scaffolding and suffers life-altering injuries, and that specific subcontractor secretly let their workers' comp policy lapse to save money, the injured worker will immediately look up the chain of command and sue the massive general contractor for the medical bills.
The certificates interlock to create an unbroken chain of risk transference. The general contractor uses the certificates to mathematically prove that the risk of employee injury has been successfully transferred to 50 different capable insurance carriers, completely insulating the massive project from a catastrophic, cascading liability failure.
It is the ultimate real-world manifestation of risk management. And of course, because every skyscraper project, every vendor contract, and every corporate lease is unique, standard boilerplate policies rarely suffice. This is where the final tool of the trade comes in. Endorsements.
Endorsements are the ultimate customization tool. They are formal, legally binding memorandums physically attached to the standard policy form that explicitly modify the foundational terms. They can dramatically expand coverage, definitively exclude highly specific perils, or alter administrative conditions. It is how underwriters surgically tailor a standardized legal framework to fit the messy, bespoke realities of the modern corporate world.
Whether it's excluding a specific hazardous chemical from a fire policy or expanding a liability policy to cover a company's newly opened overseas branch, endorsements are the living, breathing adaptations of the contract.
Looking back at the incredible ground we have covered today, I hope we have thoroughly achieved our mission. We set out to shatter the illusion that insurance is just a mundane financial obligation. By diving deep into these sources, we've exposed the profound legal and mathematical architecture beneath it all.
I think we definitely have.
We started with the strict mechanics of the aleatory contract and the rigorous categorization of risk. We explored the immense actuarial challenge of calculating premiums via the law of large numbers. We analyzed the stark philosophical divide between indemnifying a physical loss and providing a guaranteed benefit for a human life, highlighting the massive computational power required to manage those long-term liabilities.
Like the Sahara India case.
Exactly. We saw how bespoke underwriting allows mega events to function despite the threat of illness or terror, And we dissected the ruthless, brilliant legal doctrines, insurable interest, utmost good faith, subrogation, and contribution that aggressively police the moral hazards and keep the entire global pool of capital from collapsing.
It truly is a remarkable ecosystem. It is a system meticulously designed to balance the brutal uncertainties of the world. It provides the financial safety net that allows individuals to rebuild from personal devastation. It provides the secure legal scaffolding that allows corporations to take massive innovative risks without the paralyzing fear of bankruptcy. And it quietly underwrites almost every physical and commercial interaction in modern society.
It is the invisible engine of progress. But as we wrap up this deep dive, I want to leave you, the learner, with the final provocative thought to turn over in your mind. We spent a lot of time today discussing how dynamic risks, perils resulting from rapid technological shifts or sudden economic obsolescence, have historically been deemed uninsurable because they defy static, predictable historical data.
Right.
But look at the world we are entering. We are moving into an era of hyper-accelerated technological change. Artificial intelligence can render entire software industries obsolete in months. Global supply chains can be paralyzed overnight by sophisticated cyber attacks. The most catastrophic threats to a modern corporation are no longer physical fires burning down warehouses. They are the sudden dynamic shifts in the digital and economic landscape.
It's true.
If the fundamental nature of the threats facing global commerce shifts entirely from static to dynamic, will the centuries-old actuarial definitions of insurable risk be forced to evolve? Will underwriters find a way to mathematically model and insure the unpredictable chaos of the AI era? Or will corporations be forced to face the greatest risks of the 21st century entirely unindemnified?
That is the multi-trillion-dollar question keeping chief risk officers and global underwriters awake at night. The legal mechanisms we explored today were forged in the Industrial Revolution. Applying them to the digital revolution is the next great frontier. It will be absolutely fascinating to watch how the legal architecture adapts.
Thank you so much for joining us on this deep dive. We hope you walk away with a completely new respect for the invisible legal forces shaping the commercial world. Keep questioning the systems around you, keep looking for the hidden rules, and keep diving deep. We will catch you on the next one.